today's episode. This is episode 12, which means we have officially done 3 months of weekly videos, which is awesome. We're so happy with everybody who has tuned into our videos, everyone who's participated in our contests. It's been a really good 3 months, very fast 3 months as well. And of course, if you're new to the show, or you have forgotten who this gentleman is, I'm just going to introduce Joe. So he is our host for Canadian Mortgage Weekly. Joe has been in the mortgage industry for over 10 years, extremely knowledgeable, lives in Aurelia. We operate in all of Ontario, a lot of the times in the Barrie region, Simcoe. But Joe, it is so good to have you with us today. How are you doing today?
I'm doing okay, Sam. Thanks very much for that wonderful introduction. It's been a very crazy week as usual in the mortgage market. So the fact that we always find time to do these episodes every week is a really it's almost like a nice break, but it's almost really hard to find that time to carve out to do these episodes. So I'm really glad to be here, episode 12, that we've been doing this consistently, and we're really excited today because we got some really awesome information planned. And right back at you, Sam. I mean, you've been just let's introduce you to everybody. Sam Thompson. Sam Thompson. He's a mortgage agent with Mega Mortgage here in Barrie region, living in Barrie, originally from Ottawa. And Sam became a mortgage agent just over a year ago now. He's been loving it, dealing with a lot of purchase mortgages, some refinance mortgages. So that's great. And Sam, I know that you're into folk music as well, and you play the guitar, which is really awesome. So yeah, good to have you on the show as well, and looking forward to chatting about today's content with you.
Yeah, thank you for the introduction. Yes, I do like folk music.
Yeah.
It's kind of a niche genre that some people I think either like it or you don't like it. I think because I'm more of an acoustic guitar person, I like all the finger picking and that. But because you also play, right, Joe? Play quite a
I
bit.
do. Yeah, I love playing guitar. I've been playing since I was in just 13 years old. I remember picking up my brother's guitar when he was taking lessons, and thinking, wow, I really like this, and I want to learn some songs myself. So it's been a lifelong thing. And myself, I'm not too into folk music. Like you're saying, it's a pretty niche thing, but maybe that will change eventually. But I can appreciate all types of music, but
Right.
folk in specific, yes, there's a lot of finger picking involved. So it takes a lot of dexterity to have the ability to have that sort of like to play that way. So how long have you been playing for, Sam?
Yeah, I picked it up in probably when I was 14, 15.
Oh, nice. Yeah.
Yeah, my parents found a discounted guitar at the music store. A horrible guitar when you think about it now. The neck was all warped. It was, I think, $99, and then just sort of progressed from there. But yeah.
Yeah, that's excellent. That's how most guitarists start. I find that it's either on a discount guitar like that or something of the sort. And then if you learn to play on a guitar that's like that, then once you get yourself a really nice guitar, it just sounds that much more amazing.
That's right.
Yeah, yeah. Well, that's great. So looking forward to chatting with everyone today about our content. And Sam, glad to have you with us. Today we're going to be continuing our series, our 4-part series in refinancing. So Sam, last week we talked about refinancing as well. Specifically last week we had an awesome guest, Mike Crofts, Money Coach Mike. He's Dave Ramsey certified, and he was giving us some great information as to like why refinancing for a lower rate helps and helps clients. And we covered all that. But today, what are we chatting about today?
Today, we're going to be talking more about eliminating debt. So this has been a super common topic that we've gotten from a lot of clients reaching out to us with low rates. They're creeping a bit, but they're still quite low from where we were a year ago. But I think we're seeing a lot of people coming out of the lockdown over Christmas, with more debts, and interested in trying to see of how they can consolidate some of those credit card debts they got into, maybe lines of credit. So I think we'll go through about 7 questions, which leads me to another point that I don't want to miss out on, is that if you have any questions during the duration of this video, last week's video, or the next 2 in the series, please drop it in the comment section, because we do have a very special draw that we are going to be doing on April the 14th. For anyone who shares the video, writes a comment, or asks a question in the comment section, or through direct message to facebook.ca/bemortgagefree. And if you have an entry in that, on the 14th, we're going to be doing a draw for a $100 gift card to the retailer or restaurant of your choosing. So it's a great way to have your question answered. We would love to discuss it with you, get the ball rolling on some refinancing options, and yeah, don't miss out on that opportunity.
That's great. Yeah. $100 goes a long way towards, a retailer or restaurant of your choice. Maybe you want to have a family get together once this Corona thing is done, or have a big date night for yourself, or just go out on a mini shopping spree, whatever you need to do. We want to help you with that. So if you can ask us a question, as Sam was mentioning, or share our video or anything like that, that would be fantastic. So let's just jump into our presentation then. And as we take questions, we have our chat app open. So anyone that is commenting on all our channels, whether it's on YouTube, Facebook, we are on Twitch now. So search for us on Twitch, and we can help answer your questions live, or if you send us a question after the episode is aired, we'll make sure to get back to you, either Sam or myself, after to address those. So this week we're talking about eliminating debt, as Sam mentioned. So I'll just get into my presentation here, and we'll cover it off. And I'll just get out of just loading the wrong app right now. Here we go. No, I don't want Outlook. Okay. Thank you very much, Microsoft. Okay, just give me a second here, and I'll get out of that. Okay. And we'll just share the correct screen. So I don't know if you guys can see this right now. Are you guys able to see that?
Yeah, looks good.
All right. Fantastic. So as we are covering this, what I wanted to do is just really get into what it looks like to refinance and to eliminate your debt. And I have a lot of questions about this myself as a homeowner that I had when I first refinanced. So I'll cover some of those. And we've included some questions that our homeowners that contact Sam and myself and Terry Lynn, and how they want and what they need to know. So we're going to try to cover those top 7 questions and sort of the process involved with refinancing to eliminate debt. And then we'll give you a real life example at the end of this episode to show you how exactly it can impact your family in a very positive way. All right, so moving on, we can see, why would someone want to consolidate their debt into their mortgage? They are probably thinking, I don't want to have their debt in my mortgage because it's probably not good, sound financial advice. However, it does give you lower monthly payments. It will provide you with higher monthly cash flow as a result. And the benefit of that is, as a homeowner, you can take that savings of the cash flow, and it empowers the homeowner to take that cash flow and put it towards what's most important. And you can see that it can include either doing extra prepayments right back onto your mortgage with that savings, which can really eliminate debt so quickly and offset any of the lower interest that you put into the mortgage, can really accelerate your savings or investments if you're planning to retire or do something like that, or saving for something. or if you have some planned spending coming up, whether it's a child going off to college or university, or you have some home renovations coming up that you need some extra cash flow for each month. All of these options and all these strategies are a really good thing to have a reason for consolidating your debt into your mortgage. Wouldn't you say so? Sam, you've seen some of our folks that have consolidated their debts into their mortgage yourself now that you've been with us for about a year.
Absolutely. It's quite a process when we get to the illustration, when you see the amount of cash flow savings that there are each month. Again, as you were saying, there could be concerns of thinking, I want to get out of my mortgage. Why would I reconsolidate? But like you're saying, those savings that you have each month that you would typically be paying for, a higher interest credit account or some sort of loan, that can all be in the form of a prepayment now directly on principal of the mortgage. So it really is a helpful tool using debt consolidation. And I like how it's worded there, of it empowers the homeowner, because it gives you control of what to do with your money rather than it automatically being withdrawn to all of these different monthly payments.
Exactly. So let's look at finding out how much someone can consolidate in their mortgage and how they would find that information out. So 4 key items that your mortgage broker or agent will need to know when you're going into looking at refinancing to include debt in your mortgage is approximately what your home is worth, which you can get off of realtor.ca by looking at some listings, although lately those prices are about $100,000 less than what the houses are actually selling for.
That's right.
You can contact your mortgage broker or agent, and they have access to systems that can show you what has recently sold in your area. For example, for us, we have 2 different systems we use to either look at comparable sales for years before and the trends in your neighborhood and see what your neighbors are selling for. And we have another system that can even show us what the sold to listing prices and all that information, and in your neighborhood exactly how much more those houses are selling for, to give you an idea of what your home is worth. Also, it's good to know what your mortgage amount is. Surprisingly, a lot of people don't have that information off the top of their head. So just, you can look into that a little bit. Also, do you have a penalty if we were to refinance? And exactly how much total debt do you have? So that could include things like car loans, lines of credit, credit cards, furniture loans, Sam, as well, right? I think we could even look at like sometimes people have judgments and collections and CRA arrears as well. We can look at that as a separate thing, but usually it's just the credit cards and lines of credit and car loans. Yeah. Okay. So how long does it take? And I'm sorry, this is a little bit small, but the total time that it takes is approximately 4 to 6 weeks. That's the average amount of time. And then looking at that, what takes the most amount of time out of the whole part of the process is actually obtaining the documentation from the client. So if as a client, you can have the documents prepared and sent up front, your process will be much smoother and much quicker from the very beginning, because it can take 4 weeks or possibly less at that point. Right? And the next steps after that was we secure mortgage approval based on what your goals are and all your documentation. Once we secure your mortgage approval, we take a look at the inspection, the appraisal inspection on your home. And the appraisal inspection determines the actual market value of your home, which, as we mentioned, Sam, are about $100,000 over list price these days. Is quite crazy.
Yes, that's right.
And then from that point, once everything is done, the documentation is done, the approval has been secured, and the appraisal report has been received and accepted, then we will then communicate with your lawyer to make sure that they follow our instructions and execute them the way that we have laid it out for you. And then the lawyer will then pay out your old mortgage and set up your new mortgage and pay out all your debts. And then if there's any money left over, which we usually try to have some money left over that goes into an emergency fund, you will get that as a check or a direct deposit.
Right.
So you might be thinking, how much does this all cost? And Sam, mortgage penalties are one thing, and that's something that a lot of people are concerned about these days, wouldn't you say?
Yeah, and that's definitely something we also do see takes up some of that time. Is sometimes there is with the high volume the lenders are processing right now to actually get that penalty amount can sometimes take a few days to process, and that's a big thing because as we've seen. And if you've seen any of our webinars, some banks and some penalties are quite high. So that could also be a very like determining factor of is it worth it to refinance, because depending on what penalty you're paying to refinance, it could influence you either way.
It definitely can influence you either way. And we'll actually cover an example of someone paying a penalty to refinance in just a little bit here. There's also lawyer costs, which, Sam, we usually see around $2,000, give or take. Obviously, you may have a connection with a lawyer that you've used before, so make sure that you do shop around. Appraisal costs are involved if applicable. And these few expenses here, the appraisal, the lawyer, and the mortgage penalty, they're all if applicable at this point.
Right.
So then what else do we have here? I just can't see what I wrote there. So there's other fees as well. So say if your credit is poor, or we need to have a lender do manual underwriting, there are some lenders that charge extra fees for poor credit. And these are credit scores for folks that have been or are in currently a bankruptcy or currently in a consumer proposal. There are higher fees associated with those types of mortgages. And what we do is we always try to be upfront to let you know what those are before anything is signed and anything is locked in. And then from that point, most, if not all of these fees are usually included in the mortgage for you. So there's no upfront costs.
And I think we go through that in our illustration at the end. Typically, whenever we do a refinance and we're looking at a new mortgage amount, we will include a cost for an appraisal, for lawyer, and to pay off the penalty. So as you're saying, there's no immediate prepayment at the start of it just to get the refinance. We can typically add all of them into the refinance as well.
Perfect. Thanks very much. So just an aside thing, and this is another question that a lot of folks ask me, is does it hurt your credit? Does it hurt my credit if I'm going to refinance and include all this debt into my mortgage? And our take is that no, it actually improves your credit. And these are the reasons. First thing is there's only one credit check done to assess your refinance application across all the lenders. And as you've seen, Sam, we can work with all these lenders, and they just use that same credit bureau.
Yeah.
So once the refinance is completed, your credit bureau is updated to show that all your balances on your credit cards and your lines of credit and your car loans have either been paid off or reduced, which increases your overall credit availability and lowers your utilization ratio. And then as a result, your credit score will actually increase about 2 to 3 months post refinance. And that's providing, though, that those accounts that we've recently paid off or reduced are still in that paid off or reduced status.
Right.
So we talked about this just recently, Sam, there earlier on. One of the main things that takes a while for us to process a refinance application is the documents that are required by the lender. And, even though that person got their mortgage when they bought the house, maybe 2 or 3 years ago, they still need to provide documentation that is current, so the lender can then reassess to make sure that there is enough income to cover this new mortgage.
And it is all quite common to what you expected to, or what you needed to provide to get the mortgage in the initial status. So it's just an employment letter and pay stub confirming that, since getting your initial mortgage, nothing's changed, or maybe you've gotten a raise since you got your mortgage. If you're 2 to 3 years in, that can also help the process as well. And then we're also going to be looking for mortgage statements and property tax bills. These are things that, again, are added into that timeline of how fast we can process. And they're somewhat out of your hands in the term of a mortgage statement of, reaching out to the lender and getting that information, as well as just T4 slips and a void check to confirm your banking information and what you're using for that.
Excellent. Yes, absolutely. Void checks is something that I find when I say void check, most people don't even have checks anymore. So
That's right.
an account information form is just as good for that. All right, I just wanted to check something here. I just wanted to check if we had any questions, making sure that we are not missing anything as we move ahead. And if any of you are out there and you're thinking letter of employment, well, that's not really something I can provide because I'm self-employed, give Samurai a call. We can discuss what is needed in those certain circumstances, because this will depend on how long you've been self-employed for and your credit history as well, because there are almost 2 to 3 different categories for self-employed mortgages.
Mm-hmm.
All right. So looking at an illustration, and this is where I get really excited, Sam. This is where we can really show our clients how much really a refinance can change their lives.
Mm-hmm.
So let's look at a typical example, an example that was done fairly recently here. We've taken out any names and changed the amounts slightly just to make sure that the identities are protected. But this is an example of someone that bought a home just a few years ago. They have a mortgage outstanding of $265,000, a car loan outstanding of $35,000, a Visa card outstanding of $11,000, a MasterCard outstanding of $17,000, an OSAP student loan outstanding of $27,000, and a line of credit that has been run up at $8,000. Now, Sam, this is pretty typical for what we see when people come to us for a refinance, wouldn't you say?
Absolutely. I think most, if not almost all of the applicants that I've processed all have a car loan that is in repayment. And again, especially with the COVID scenario over the last chunk, we're seeing accounts like, especially line of credits, that maybe in the past they really only used in emergencies or time to time. They're needing to use those funds. And now they have this big line of credit that they don't know, how to handle because they just needed it to get by. And I mean, you can see on the right there, all of the monthly amounts that are being paid are quite standard for what we see on a lot of our applications, but it really does start to add up over the month of how much you're paying out.
It really does, Sam. And, it may not seem very much at the time when you're taking on that car loan after you've bought your home. And then it may not seem like very much when you're just taking out that extra amount on your Visa and MasterCard to purchase, some furniture and some items for your home, like curtains and blinds.
Mm-hmm.
And then in the background, you still have that OSAP payment. And then all of a sudden an emergency hits, maybe a furnace blows up or something, and then you got a line of credit on there. Yeah. Speaking of which, we have some lenders that offer warranties for free. If you take your mortgage with them, that can cover a blowing up furnace. So that's really key. So you don't have to worry about that $8,000 on the line of credit from the very beginning. Those are really good for first-time buyers, because typically if anything is going to break, in my experience, it's going to be within the first year after you move in.
Murphy's Law, right?
Murphy's Law. So you can see in the background, you have that couple. They got their coffee pot. They got their calculator. They're just trying to make things work. Maybe you're in the same situation and you feel like, you're just working for, and all your pay is going from one pocket to the other, and you want to have some more cash flow every month, because $34.81 a month just for debt repayment is quite substantial. And there's no one that needs to be in this situation if they have the equity in their home.
Absolutely.
Yeah. So let's look at a scenario that would turn around this family and really show them that, let's show them how we can really change their lives here. All right. So here we are. So to do this type of refinance, we would need to increase the mortgage to approximately $375,000. And then from that, Sam, we would take $363,000 and pay off the old mortgage and all the debt. So that would be the MasterCard, the Visa, the car loan, the OSAP loan, and the line of credit.
Wow.
Yeah, we talked about mortgage penalty being a cost. In this case, it's $4,500. However, in most cases, we can show you if that's going to make sense, because usually paying off the higher interest debt as well as securing a currently lower mortgage payment will actually put you ahead in a few months, even though you're paying that penalty. And we usually include that penalty. In this case, we are including that penalty in the new mortgage balance. And to pay the lawyer to do their work, if applicable, it's about $2,000 for that amount of work, which leaves us about $5,500 to go to your emergency fund. Wow. So you don't have to go back into debt once you're out of debt. And you can stay out of debt simply by having an emergency fund to tap into and having that instead of going into debt. Because once you get into debt, it's hard to get out of debt. So looking at this, $5,500 to the client's emergency fund, that would be pretty good for me, Sam. I don't know about you, but having $5,500 in an emergency fund, it can go a long way to helping with cash flow and just managing all that.
Absolutely, yeah. And it's so important to have an emergency fund, because like you're saying, once you get in debt, it's hard to get yourself out, and it feels like it keeps building and building. So if you do have a fund that's there in your own money, there's no borrowing involved, it really can help, keep the cash flow flowing and not freezing up by making all of these repayments.
That's excellent. So as you can see, we're comparing now the total payments before, which was $3,481.08, which these clients were managing, but it's probably keeping them up at night a little bit, and it's really making them at this point house poor, and they're not able to really do much. And in COVID, that might be okay, but let's take a look at what can happen after. So after setting up the new mortgage at current rates and including all these penalties and legal fees if applicable, really brings the payment down to $1,391.97 per month, which is amazing. It's actually going to save them and open up $2,089.11 in cash flow per month. Yeah. So quite a big savings.
That's right.
Yeah. So, sorry, go ahead, Sam.
Yeah, no, I was just saying it's also wild to note as well that just the monthly mortgage payment is only, $30 more than the original mortgage payment. So you're actually, yes, you're consolidating all of that, but even in just looking at the mortgage side without debt repayment, you're getting a bigger mortgage for minimally higher mortgage payments, which is also, it definitely helps. And that sort of is a call to arms, if you want to say that, for the current rates that we're seeing, that just in what you would qualify for, your payments are essentially staying the same for between the two mortgages, and you're able to consolidate all of that debt into that one payment.
Yeah, it really makes a difference, like you're saying. And this is where it opens up the cash flow for you for a client or homeowner to be able to take their cash, and then, you know what? if you felt that originally refinancing your car loan because it was at a lower interest rate, maybe 0.99, was a bad idea, well, having this extra cash flow now allows you to plunk that back onto your mortgage and really reduce that mortgage balance quickly. And in turn, like, you're paying off your debt faster now than you would have otherwise. And if any of you are out there thinking that refinancing is still not for me, I want to do this by myself, I want to save my money and pay this off without tapping into my mortgage, I feel like the costs are not worth it, give us a call. We have a really advanced calculator that can show you exactly for the remainder of the term how much the rate will save you compared to staying your old rate, including the penalty and legal fees. So we can actually show you your break-even point, and then you can make your decision from that point. And then it's just numbers. And at the end of the day, if the numbers make sense, we need to take our emotion out of it and really look at what is financially sound for your plans. Mm-hmm. So looking at this, Sam, when I see savings of $2,000, like additional cash flow of over $2,000 a month, and it's only going to raise my mortgage by $30. Mm-hmm. I mean, you're probably watching this on your laptop right now thinking, how does this actually work?
That's right.
So let's take some questions. If there's any questions right now, do we have any comments or? Mm-hmm. And if there's not, and if there's no comments or questions, we can continue chatting here, because I guess not yet, but that's okay.
Mm-hmm. Yeah, no question at the moment. But again, if you're watching this later than when we're live right now, because the video will be available for the rest of the week until our next video. If you do have a question, you're rewatching it, feel free to leave it in the comments section. We would love to reach out to you and discuss your options, as Joe was saying, really getting out and chatting to us about if refinancing would work for you is going to be your best step, because we'll be able to help you, decide if now is the right time, if the numbers make sense, if you want to increase that savings. And also, any question that you enter into the comments section is also an entry into our draw, which again will take place on April the 14th. So there is still lots of time, but you don't want to miss out on a $100 gift card to the retailer or restaurant of your choosing.
That's great. Yeah, thanks for the reminder, Sam. So I can't wait to give that out on April the 14th. Really looking forward to seeing our basket of draw there, and we'll bring out the drums there. Maybe I'll bring out a special thing for that day for that big prize. Mm-hmm. You know what? We'll have to see how many entries we get, because maybe I'll play the whole drum set that day. I don't know. We'll see. But yes, give us a call or text or email. We'll be happy to go over how this will work for you. We've seen lives changed by people refinancing to pay off their debt, and we want that to happen for you. So, and join us next week as we start episode lucky number 13, as we continue our 4-part series into mortgage refinancing. We got 2 more episodes left. So we're doing also refinancing for home improvements. And we're also doing an episode on refinancing to purchase another property, which could be like a cottage or an investment property. I know that we do work with a lot of investors, and we do work with folks that do want to purchase cottages. So if that is someone that is like, if that's who you are, stay tuned. I'm hoping that we have a special guest. Perhaps we'll have a seasoned investor join us for that episode. Mm-hmm. And also for the home improvements, we'll hopefully be able to give you some good insight as to how that all works and how to get started on planning your home improvement project and using the funds for that from your mortgage.
Mm-hmm.
Okay. All right. So I guess if there's no other questions here, we can call it a day. Thank you for joining us. And thanks for joining us in episode 12. And we'll look forward to seeing you next week at 10:30.